Hello YouTube, my name's Steven. I want to thank you for stopping by my channel. It's all about financial independence, retire early. There was a big push for this probably about 10-15 years ago, mainly with bloggers. If anybody followed a guy, Mr. Money Mustache, it was a pretty entertaining blog that described what you could do to invest your money now at a younger age and be basically a super saver and put that money away and let it start working for you at a young age. As you approach your 50s, and maybe even in your 40s, try to think about an early retirement and how you can accomplish that by having all that previous savings working for you for all those years. So I just want to do a quick introduction video just to kind of explain what I've been going through, my path, where I'm at, and what I plan to do. I'm currently on year 12 of investing. And prior to that, I didn't really understand the market enough. I did do some trading, mainly just in-out day trades, which are considered short-term capital gains. And because I did that in a taxable brokerage, I had to pay taxes on that money at the highest income bracket after my deductions during those years. So that was back in like 2005 to 2006. I did make a little bit of money. I did lose some money. In the end, it wasn't really worth it. I realized that the risk reward just isn't there. You have to take your time with investing. And at least for me, I'm not one of these people looking at charts that are by the minute to take very large sums of money and trade it on a high risk just to make a few dollars. To me, it's just not worth it. Everybody has their style. And when you learn about investing, there's so many different ways you can go about it. You don't have to do it like everybody else. You just have to find your style that works for you. And what I found that works for me is just putting a little bit of money towards a fund or a stock and building that position over time. Some stocks pay every quarter, so it'd be every 3 months you'll get a dividend, and that comes out of the price of the stock. It's not like you just get the money for free. So if the stock was trading at $25 and you get 50 cents, you're gonna get the next morning that it goes to an X dividend date, it's gonna be at $24.50. It'll start trading from there. It'll go up and down. It may go higher, it may go lower. You really don't know. So basically, you just want to keep accumulating shares. For these funds and REITs and ETFs, they'll pay every month. And you can build huge positions in these by doing compounding. And what you could do is you could set the account to reinvest and buy more shares. So even if you only get $1.50 in dividends for that month, it'll reinvest and buy a fractional share. The next month it'll buy even more. Hopefully you're putting new funds to work and you're buying additional shares on your own. The compounding will work even faster. So I've built positions in a Roth IRA, a taxable brokerage, and a workplace 401k. Now each one has its advantages and disadvantages. For the first one, I would say the workplace 401k is probably going to be the one that's most accessible to most people because your company is going to have a sponsored plan. They're going to have something in place already, and you can get the details from your plan administrator or your HR, and they'll give you the information. And what's great about those is the money goes in tax deferred. So let's say you put in $100 per check, and the rest of your check, let's just say you make $2,000 for that check. Well, you're only going to get taxed at $1,900 for federal and state because it's not getting counted towards taxable income. So the more you can put away in that, the less you'll pay in taxes. Hopefully at a higher bracket, it'll reduce you, and that money will grow over time. So I really, when I talk to people that haven't set up an account yet, I say, you know what, just look at your budget, get your credit card bills in order because, you're probably paying somewhere between 15 and 20% interest rate on those cards. You want to get rid of that. You don't want to have that debt on your account because realistically in a market, you're probably going to make somewhere between 5 and 15% in a year. You might make a little more, you might lose some. But the whole idea is just to keep contributing to those accounts. So the reason why I say the workplace 401k, those accounts are set up for the most part, the company will also offer a match. And with the match, they'll say, hey, if you put in 6%, we'll match 100% of that or we'll match 50% of it. My company does a weird percent. It's something like around 60-something%. So at a minimum, I'm always going to put in the percent to get that match because that's basically free money in that account, tax deferred. So throughout the course of the year, it's gonna add up to a couple $1,000s. So you definitely want to take advantage of that. And what it's gonna do is whatever percent you have to your funds in your 401k. Could be a S&P 500, small cap, international. You're going to have to look through all the options. Whatever percent you set them at, you'll get a proportional amount usually allocated from the match. So you get a few extra dollars going towards it that you don't have to contribute. So right off the bat, you're ahead of the game because you're getting free money from the company. Whatever percent they match, you definitely want to take advantage of that. And think about it. If you do that for 10, 15, 20, 30 years, that money is going to build up and just become a snowball working in your favor. So probably going back to 2012, 2013, I think I was auto-enrolled at one point within the 401k, and I didn't see an advantage to it. My taxes were pretty low. My limited understanding at the time, I just didn't think it made sense. I wanted to pay down my mortgage. But looking back at it, I had an interest rate around 5% on the mortgage. I could have been tax deferred on that, the amount, and receiving a match on the company plan. Now, it wasn't very much at the time. It was only like a 25 or 30% of what I put in for the first so many percent. So for example, if I put in the max, let's say 6% to get that match, I might get like 1.5% extra towards that match. So, I did miss out on those years and I didn't put money towards it. I did pay down my mortgage quite a bit, but then I ended up refinancing a couple years later, and I basically set it up as a line of credit on my home. So whatever I borrow, that balance is what I pay interest on. And the big disadvantage of that is it is subject to the Federal Reserve rate, and they generally add 3% to what the Fed funds rate is. But with the company I have, it's a small regional bank back east. They actually give you 1% below the prime rate. So currently I'm sitting at like 5.25%, which is manageable. But a couple years ago when they were raising the rates, I was at 7%. And that definitely hurt because I did have to move some money around. And, I was basically making the sacrifice at the time. I wanted to put more money into the 401k and take advantage of the match, and the market was down. So to some people, you might get upset and say, hey, I'm just putting money in this and it keeps going down over and over again. Well, it ended up being a really good move because all those years that I put, pretty close to the max amount into the 401k, it compounded, and pretty much I'm at a double from what I put in from that time. And generally it's going to take somewhere between 6 and 8 years for your money to double in an account. So it's not like a quick process at all, and you're going to definitely see your account go down, and it's going to be very discouraging. And so I just want to start this channel to talk to other people that are investing, whether you're doing FIRE or not, for this financial independence, retire early. Let me know what you think about that topic. It's something that actually kind of went on the back burner in my mind, even though I was all about this, about 10, 11 years ago, because now I'm living it, and it's like, I think I can handle working because I am able to work remotely. I don't have to go into the office, and I can still maintain a taxable trading account that I can control and look at it on my breaks and my lunch hour and see what I want to do for the day. I'm definitely not a day trader, but I have a stream of income coming in from these taxable accounts, and that allows me to say, look at the market and go, wow, the S&P is down 15% for the year. It's selling off. It's, everybody's panicking. Well, that's the time that I say, take my 401k from 15 or 20% to 25 to 30%. And I want to put more money into those accounts during that time. I won't get any extra match. I'll just get the match to the limit. But what it's doing is it's buying while it's low. And there's fund managers that are managing these mutual funds that you have in your 401k, and they're doing the work for you. So once you get out of the, let the dust settle, get out of this panic time, you'll be doing great. So you just got to be willing to put the money in when it doesn't feel comfortable. Okay, so you kind of want to be in the loop though of what's going on. So for example, during COVID in 2020, I have cash in those 401k accounts. I have them either in a short-term bond or in a money market, and they don't earn very much. But the reason I do that is I set aside somewhere between 10 and 20% of the 401k, which can actually seem kind of high to some people. But basically what I'm doing is I'm just keeping it there as a stable amount that just builds a little at a time. And if the market keeps going up, great, that money's there. I don't need it. But all those months, all those years that I just let it sit there and just earn the 2.5 to 3 or 4%, that money is available during a market crash, and now I can transfer it into a fund. And there's usually rules with these 401ks. So you want to take your time, get used to it, watch your budget monthly, and see what you can put in there. If you can put in $50, just get it started. Get that match. Don't even worry if you don't get the full match. You just want to let time be your asset. And I think that's the biggest takeaway that I got from starting accounts. I used to think, oh geez, I need to put this money in, I better get it out. Well, I was trying to do big trades. I was trying to put in like, $2,500 or $3,000 at a time and see if I can make 10% in a week. And it doesn't really work like that. If I did do that, I'd be subject to taxes on that short-term gain. And then I'd want to do it again. And maybe it goes down more the next time after I buy it and I'm stuck with it. So I kind of had a mix, mostly successful, but a lot of frustration, because eventually there does come a time when you buy a stock that you've been buying over and over again. And again, this isn't a personal taxable account, not a 401k. This is a single stock, so it's a little bit riskier to do this. And I didn't really know what I was doing, but I figured, let me see if I could figure this out. And through trial and error, you'll find your style. So I'd say take your time, get used to looking at stuff. And if you are going to talk about it with a coworker, I'd keep it pretty basic. You don't want to disclose your salary or get into that, because people can get upset. You don't want to compare balances either. If you've been in the 401k for a year or two, you don't want to ask another person, hey, how's your balance? Maybe they've been at the company longer. Maybe they have, they can select an advisor and pay a fee to have somebody manage it for them, and maybe you don't. So these are all things to consider. You don't want to compare yourself. It's just going to make you feel bad, or it might make the other person feel bad. So I guess in the takeaway from my opening video here, it's a lot of trial and error. Take your time, get the account set up, balance your budget monthly, and just work on setting up a system, whether it's every paycheck or maybe once a month, however you get paid. Set aside some money so you can put them in these accounts and let them start growing and working for you. I had to just do it blindly, not knowing. Nobody was there to give me any advice. But one thing I can say is I did learn a lot from listening to podcasts and listening to other people's opinions on call-in shows. As crazy as it is, Mad Money with Jim Cramer, I did learn quite a bit about that, just understanding the investor mindset of a caller. They screen that stuff, and they're looking for kind of sensational topics to get you interested into watching that kind of show. You just got to take it with a grain of salt. When you're starting out, you probably want to stick with sector-based mutual funds or ETFs. And what that means is it's a financial or, utility, or, it could be anything, a REIT, real estate investment trust, but it has many companies inside of that, and that balances your risk. And if you're one of these people that doesn't want to lose money, you probably won't make as much if you do single stocks, but you cut the risk down quite a bit, and you won't lose all your money. So you're going to have to do your research to see which ones work for you. If you're going to opt to do a Roth IRA, you're going to have to select those funds on your own. And you could do mutual funds in them. You could also do the ETFs, which is basically like a mutual fund, but you just trade it yourself. There's so much information with all this stuff, it's very overwhelming. So if you're new to this, I'd love to see questions, share your experience. If you're currently doing FIRE, heard about FIRE, know somebody who did FIRE, or just general investing, I'd love to hear what other people have to say. I don't think anybody's system is perfect or necessarily the right thing for everybody. You got to see what works for you. You got to look at your budget. You got to look at your whole financial picture, the money that comes in versus the money that goes out. So if you do some preparation, you can, plot out, use Google Sheets. That's a huge resource that I do. And use the Notepad app, or just notes, like a Google app for Word. These are all free. And you want to track your progress, and it helps keep you motivated. Write down some goals. When you write down goals, you tend to stick with them. And so I've done that for all kinds of things, whether I'm trying to play guitar, write songs, personal goals that I have, things that I'm working on, long-term, short-term. It's good just to make these lists and just get it out of your system. It's hard sometimes to express these things to other people because they might not be interested in it. So my best advice for this kind of thing is just mainly keep it to yourself. If you're married or you have a partner, discuss the budgeting of what you want to do in terms of how much you want to invest per month and if you could afford it. But my main advice is just get started. Don't worry about it. Just get it going. The time is your biggest asset, and if you don't get it started, you keep delaying it. And that's one thing that I kind of regret from my younger days. I really didn't start my investing in my retirement until I was about 35. So, you know, now about 10, 11 years later, I did get it going and it's working for me. So thanks again for stopping by, and I'll see you in the next video.